Friends, thank you for being here today. What if I told you that on December 10th, while you were shopping for groceries or scrolling through holiday photos, the Federal Reserve quietly flipped a switch that changes everything? What if I told you they just restarted the money printer, but this time they're refusing to call it what it is? Let me be precise. On that date, the Federal Reserve announced they would begin purchasing $40 billion per month in Treasury securities, $40 billion every single month. But here's the part nobody expects. They explicitly refused to use the term quantitative easing. Instead, they invented a new label, reserve management purchases. This is not theoretical, it's observable. When a central bank buys its own government's debt with freshly created money, that is quantitative easing. The mechanism is identical. The outcome is identical. They simply change the wrapper to keep you from panicking about what's really happening. And this part has already begun. Let me show you the scale of what we're dealing with. $40 billion per month. That's not a trickle of emergency support. That's a fire hose of liquidity being injected back into a system they claimed was healing. This is roughly the same monthly pace as the initial QE launches during previous crises, the ones they swore would never happen again. But that's not the number that should keep you awake at night. The real metric is this, $2.8 trillion. That's the danger zone threshold for bank reserves. The moment the system's reserves dipped toward that line, the plumbing started to creak. The Fed saw something in the data that terrified them, and on December 10th, they blinked. Here's what that looks like on the ground. In late October and November of this year, overnight repo rates, the cost for banks to borrow cash from each other for just one night, started spiking. These aren't exotic derivatives or speculative trades. This is the engine room of the financial system. This is where banks go when they need cash to settle the day's transactions, and that engine was starting to seize up. The translation is simple. The banks ran out of cash. The entire plumbing system of U.S. finance was heading toward a freeze on December 31st, year-end settlement day, when every institution has to balance its books. If that system locks up, global banking stops, not slows down, stops. The Fed saw this freight train coming and pulled the emergency brake. This is where the countdown quietly began, because what I'm about to show you is not a new problem. It's the final chapter of a story that started 6 years ago, and most people have no idea it's been building this entire time. Let's cut through the noise and go back to the origin point. September 2019. You might not remember it, but the financial system nearly had a heart attack that month. The Fed had been trying to shrink its balance sheet, trying to prove the economy could stand on its own without emergency support. They were pulling liquidity out of the system, letting their bond holdings mature without replacing them. Then, overnight, the repo market exploded. Rates that normally sit around 2% suddenly spiked to 10%. In some cases, they hit 10% for overnight loans. Banks were so desperate for cash, they were willing to pay usurious rates just to get through the next 24 hours. The Fed had to emergency inject billions of dollars to prevent a complete seizure. Here's the detail even analysts tend to miss. That wasn't a one-time glitch. That was the system telling us something fundamental had broken. The U.S. financial architecture had become so dependent on Fed liquidity that even a modest withdrawal caused the scaffolding to crack. Fast forward to today, we are in Repo 2.0, and the fault line is wider. The U.S. Treasury is issuing debt at a pace this country has never seen. We're talking trillions in new treasuries flooding the market every year just to keep the government funded. Someone has to buy all that debt. And here's the crack that becomes an earthquake. The traditional buyers are stepping back. China has been reducing its treasury holdings for years. Japan, the silent giant, is now dealing with its own crisis as it tries to normalize interest rates after 3 decades of zero. Foreign central banks that once reliably absorbed American debt are now pulling back or staying neutral. The private sector, pension funds, insurance companies, banks, can only absorb so much. This leads us to the system's most crucial secret, which is the trap they cannot escape. If the Fed doesn't step in as the buyer of last resort, two things happen simultaneously. First, Treasury yields spike because there aren't enough buyers. Second, the government's interest payments explode, pushing the deficit even higher. It becomes a doom loop. Higher rates mean higher deficits, mean more borrowing, mean higher rates. Let me show you what actually happened. The Fed tried to let the system stand on its own. They ran quantitative tightening for 2 years, letting nearly $1 trillion roll off their balance sheet. They raised interest rates to fight inflation. They did everything the textbook says you're supposed to do after an emergency money printing episode. And the system started to fail, not in some distant theoretical future, right now, in real time. The repo tremors in October and November were the warning sirens. By early December, the Fed's own internal metrics were flashing red. Bank reserves were approaching the danger zone. Year-end settlement was 3 weeks away. They had no choice. This is where common sense actually becomes your enemy. You might be thinking, well, if they need to add some liquidity to keep the banks running smoothly, that sounds reasonable. That's just technical management. And that's exactly what they want you to think. That's why they branded it reserve management purchases instead of quantitative easing. But once this shifts, everything above it starts to shake. Because here's the part they're not telling you. This $40 billion per month isn't a temporary bridge. This is the new normal. The US government is running deficits so massive that the free market cannot absorb the debt supply without the Fed printing money to buy it. Let me be precise about what that means. When the central bank buys government bonds with newly created reserves, that is monetizing the deficit. It's the infinite credit card. The government spends money it doesn't have, issues an IOU, and the Fed creates the money to buy that IOU. It's a 200-page debt instrument written to itself, and this is where the first domino falls. On December 12th, just 2 days after the announcement, the purchases began. The Fed's balance sheet, which had been shrinking for 2 years, started expanding again. That trend line turned upward. The era of fighting inflation ended. The era of saving the system at any cost returned. We haven't even reached the breaking point yet, because here's what makes this different from 2019 or 2020 or any previous round of quantitative easing. They're doing this while inflation is still at 3%, not during a deflationary crisis. Not during a pandemic lockdown, during a time when prices are already elevated and the Fed's own target is 2%. They have chosen system survival over price stability. That is the policy. They looked at the two paths, let the banking system freeze or restart the printer, and they picked the printer. This is not a conspiracy. It is a stated policy, just dressed up in technical language. For the average household, this means the hidden tax is back. Because what is inflation? It's the devaluation of the currency. Every dollar you hold loses purchasing power when the money supply expands. The Fed is choosing to quietly erode your wealth rather than let the government default or the banks collapse. Here's where everything changes. The smart money already saw this coming. Look at gold. In Q4 of this year, gold broke out to new all-time highs, not because of some random speculation, because institutional investors, central banks, and family offices understood that the Fed would have to choose inflation over deflation. They positioned in hard assets before the announcement even happened. This part isn't a prediction, it's math. If you expand the money supply while the productive capacity of the economy stays relatively flat, prices rise. If you create more dollars chasing the same amount of goods and services, each dollar becomes worth less. The Fed knows this. They are betting that slow chronic inflation is politically preferable to a fast catastrophic crash. But that's not the real problem. The real problem is what comes next when the market realizes this 40 billion per month is just the beginning. Because what comes next is worse. Let me show you the mechanism hiding in plain sight. The Fed announced they're specifically buying short-term Treasury bills, T-bills, not long-term bonds, not mortgage-backed securities, short-term government debt that matures in weeks or months. Here's what that looks like on the ground. When you suppress short-term interest rates, you directly reduce the government's borrowing costs. The Treasury is rolling over trillions of dollars in debt every single year. If short-term rates spike, the interest expense on that debt explodes overnight. We're talking hundreds of billions in additional annual payments. So the Fed is now explicitly manipulating the short end of the yield curve to keep the government solvent. They're not managing bank reserves. They're funding the federal deficit with printed money. A default in all but name has been replaced with perpetual monetization. This is the moment the clock actually starts. Because once you cross this threshold, once the central bank becomes the primary buyer of government debt, not during a war or a pandemic, but during normal times, you cannot go back. The system becomes addicted to the liquidity. The scaffolding cannot stand without continuous injections, and here is where the cascade becomes unstoppable. Think about the trap they've built. The government runs massive deficits. The Fed prints money to buy the debt. That printed money flows into the financial system. Asset prices inflate. Inequality grows because people who own assets get richer, while people who hold cash get poorer. Political pressure builds to do something about affordability. The government spends more to address the crisis. The deficit grows. The Fed prints more. The loop tightens. Let me show you what actually happened in the weeks before December 10th. The data forces one conclusion. Look at the October and November repo spikes I mentioned earlier. Those weren't random. They were the system screaming that liquidity was draining faster than anyone expected. Here's the part the experts gloss over. When the Fed runs quantitative tightening, they're pulling reserves out of the banking system, but the Treasury is simultaneously issuing massive amounts of new debt. Every time someone buys a Treasury bond, they take cash out of their bank account and hand it to the government. That cash leaves the banking system. Reserves drop. The Fed thought they had this calibrated. They thought bank reserves could safely fall to around 2.5 trillion before causing problems. They were wrong. By late November, reserves were approaching 2.8 trillion and the repo market was already showing stress. The ample reserves threshold, the level where banks feel comfortable, turned out to be much higher than their models predicted. This is where the crack that becomes an earthquake opened up. On year-end settlement dates, banks need extra liquidity to square their books. December 31st is the biggest settlement day of the year. If reserves are already tight going into year-end and banks start hoarding cash, the entire overnight lending market can freeze. No bank wants to lend. Everyone wants to borrow. Rates spike. Panic spreads. The Fed saw this setup forming and realized they had maybe 2 weeks to prevent it. That's why the December 10th announcement came with such urgency. That's why the purchases started just 2 days later on December 12th. They couldn't wait for the next scheduled policy meeting. They couldn't afford the usual bureaucratic timeline. This was an emergency intervention dressed up as routine maintenance. We don't have months. This is happening in days. Because the moment those purchases began, the Fed's balance sheet started expanding. After 2 years of shrinking, the trend reversed. And once that reversal begins, once the market sees the Fed is back to being the buyer of first resort, expectations change. Bond traders start pricing in more liquidity. Stock investors start anticipating looser financial conditions. The dollar starts to weaken because more supply is coming. Inflation expectations tick higher. The entire edifice shifts its foundation from the Fed is tightening to the Fed is easing, even though they refuse to use that word. Here's the moment small businesses get crushed, because while the Fed is injecting liquidity at the wholesale level, credit conditions for ordinary Americans remain tight. Mortgage rates are still elevated. Small business loans are still expensive. The printed money doesn't trickle down to Main Street. It stays in the financial plumbing, propping up Treasury markets and bank balance sheets. So you get this perverse outcome. The government gets cheaper financing, Wall Street gets more liquidity, and you get higher grocery bills without any relief on your borrowing costs. Financial repression in its purest form. The system is rigged to transfer wealth from savers and workers to debtors and asset holders. Let me be precise about the convergence we're facing. This isn't just one problem, it's three forces hitting simultaneously. First, massive government deficits that show no sign of shrinking regardless of which party controls Congress. The structural spending is locked in. Social Security, Medicare, defense, and interest on the debt alone consume almost the entire federal budget. Second, bank liquidity drying up faster than expected as quantitative tightening pulls reserves out while Treasury issuance pulls cash out. The Fed thought they could shrink their balance sheet to maybe 5 or 6 trillion. The repo tremors proved they're stuck at around 8 trillion or higher. The system is vastly more fragile than they admitted. Third, political pressure that makes it impossible to let markets clear naturally. No administration, Republican or Democrat, can afford to let the stock market crash 30% or let unemployment spike to 8%. The political cost is too high, so the Fed is forced to intervene over and over each time the system wobbles. And here is where the domino becomes unstoppable, because the Fed just told you in December 2025 that they cannot allow the system to stand on its own. They tried, they ran QT for 2 years, they got the balance sheet down from 9 trillion to about 7 trillion, and the engine started seizing up. That means the floor is set. The Fed's balance sheet cannot go below roughly 8 trillion without causing a crisis. But the government's deficit is running around 2 trillion per year. If foreigners aren't buying and the private sector can't absorb it all, someone has to. That someone is the Fed. This part is non-negotiable. Do the math. 2 trillion in new debt per year. Maybe private buyers absorb half of it. That leaves 1 trillion per year the Fed has to monetize, but they're currently only committing to 40 billion per month, which is 480 billion per year. That's not enough. Here's what's really behind it. The 40 billion per month announcement is the opening bid. It's the toe in the water. They're starting small to avoid spooking the inflation-sensitive bond market. But as 2026 unfolds, as the Treasury keeps issuing debt and foreign buyers keep stepping back, that 40 billion will become 60, then 80, then more. This was inevitable the moment they chose this path in 2008. When you bail out the financial system instead of letting it restructure, when you suppress interest rates to zero for a decade, when you run quantitative easing to the tune of trillions, you create dependency. The system cannot function without the IV drip of central bank liquidity. And this is the part that scares me, because they know this. The smart people at the Fed understand the trap they're in. They're not stupid, they're trapped. They've built a financial architecture that requires continuous intervention, and they've convinced themselves that slow managed decline through inflation is better than fast chaotic collapse through deflation. For pensions, this is catastrophic. If you're a retiree living on a fixed income, congratulations. The Fed just announced they're going to slowly erode your purchasing power to keep the government solvent. Your pension pays you the same dollar amount every month, but those dollars buy less and less as the money supply expands. For savers, the game is rigged. Real interest rates, the interest you earn minus inflation, remain negative. You're being penalized for being responsible. Your savings account loses value in real terms because the interest rate doesn't keep pace with actual price increases. For workers, the treadmill speeds up. Wages might rise nominally, but prices rise faster. You become a millionaire on paper, but poorer at the grocery store. The money illusion is the cruelest tax because most people don't understand they're being taxed at all. But this isn't even the part that scares me most, because we haven't even talked about what happens when the rest of the world realizes the Fed is permanently monetizing US debt. When foreign central banks and sovereign wealth funds understand that dollars are being printed to cover deficits, not just during emergencies, but as standard operating procedure, they start looking for alternatives. The dollar's reserve currency status is built on trust. Trust that the US won't inflate away its debts. Trust that holding treasuries is safe. Trust that the Fed will prioritize price stability. On December 10th, that trust took a major hit. They prioritized system stability over currency stability. They chose inflation over default. And here's where the tension actually doubles, because this isn't happening in isolation. Japan is raising rates after 30 years of zero. Europe is dealing with energy crises and political fragmentation. China is facing a real estate collapse and demographic decline. The entire global financial system is creaking simultaneously. When everyone is printing, everyone is devaluing. It becomes a race to the bottom. Which currency loses value slowest? Which central bank can maintain the illusion of stability longest? Which government can keep the plates spinning without dropping them? We are facing a convergence, a structural break in dollar credibility, a domestic liquidity crisis that requires permanent intervention, and a sovereign debt spiral that has no mathematical exit. These three forces were always, but here's the detail even analysts tend to miss. The crisis doesn't announce itself with sirens and flashing lights. It builds quietly in the plumbing until one day the pressure becomes too much and something snaps. Let me show you what's really behind it. When the central bank becomes the primary buyer of government debt during non-crisis times, you are no longer in a free market. You are in a managed economy where asset prices are artificially supported, where interest rates are administratively set, and where the invisible hand has been replaced by visible intervention. That changes everything about how you should think about wealth preservation. In a free market, you can trust that prices reflect underlying value. Supply and demand find equilibrium. In a managed system, prices reflect policy. They reflect how much money the central bank is willing to print to prevent collapse. This is not theoretical, it's observable. Look at what happened after December 12th when the purchases began. Treasury yields dipped, the stock market rallied, gold held its recent gains. The market interpreted the Fed's action exactly as it should. More liquidity is coming, risk assets are supported, inflation hedges remain attractive. But that's not the real problem. The real problem is that this creates a moral hazard so enormous it distorts all future decision making. If market participants know the Fed will intervene every time the system wobbles, they take bigger risks. They lever up, they chase returns, because why not? The downside is limited by the Fed put. And this is where the cascade becomes unstoppable. More risk taking leads to bigger bubbles. Bigger bubbles require bigger interventions when they pop. Bigger interventions create more dependency. More dependency means less resilience. Less resilience means the next shock causes more damage. The system becomes simultaneously more fragile and more dependent on intervention with each cycle. Here's the part nobody expects. The Fed thinks they can manage this. They believe they can thread the needle, provide enough liquidity to prevent collapse, but not so much that inflation spirals out of control. They think they can maintain the illusion of stability while slowly inflating away the debt burden. History suggests otherwise. Every major currency throughout history that took this path eventually faced a crisis of confidence. Not because the central bank ran out of ink, you can always print more, but because people stop believing the money holds value. Once that psychological threshold is crossed, once the population realizes the emperor has no clothes, the unwind accelerates. We don't have months. This is happening in days. Not the final collapse, but the positioning. The smart money is already moving. Central banks around the world have been net buyers of gold for multiple years now. Sovereign wealth funds are diversifying away from pure dollar exposure. Family offices are increasing allocations to hard assets, commodities, and real estate. The data forces one conclusion. If the institutions that have the most information and the most resources are repositioning away from paper claims and toward tangible assets, what does that tell you about their confidence in the current system? Let me be precise about your options. You can believe the label reserve management purchases and assume this is routine maintenance. You can hold cash, bonds, and stocks and trust that the Fed's interventions will keep the music playing indefinitely. That is one path. Or you can understand this is QE infinity disguised as plumbing repair. You can recognize that when a central bank prints money to fund government deficits, the purchasing power of that currency declines over time. You can position accordingly. Here's what that looks like on the ground. The binary choice is this. Do you own assets or claims on assets? A stock certificate is a claim. A bond is a claim. Even a dollar in your bank account is a claim. It's a liability on the bank's balance sheet. All of these are paper instruments whose value depends on the system continuing to function as designed. Gold is an asset. Silver is an asset. Land is an asset. These are tangible things that exist independent of any institution's balance sheet. They cannot be printed. They cannot be digitally inflated. They are the final settlement layer when paper claims lose credibility. This is not a prediction. It's math. If the money supply expands and the amount of gold remains relatively fixed, the gold price in dollar terms must rise over time, not in a straight line, not without volatility, but the long-term trend is dictated by simple arithmetic. And here is where everything changes. The Fed's December 10th announcement was the moment they admitted they cannot escape the trap. They cannot shrink the balance sheet to normal levels. They cannot let interest rates reflect true market clearing prices. They cannot allow the system to stand without support. That admission changes the risk calculation for every asset you own. Cash is now guaranteed to lose purchasing power. Bonds are vulnerable to inflation, surprising to the upside. Stocks are dependent on continued liquidity injections. Only assets that cannot be diluted by monetary policy offer true protection. For the average household, this means rethinking the entire concept of savings. The old model was work hard, save money in a bank account, or buy bonds, and your purchasing power is preserved. That model is dead. Real interest rates are negative. Your savings are being taxed through inflation. The new model requires you to think like a central bank. What are central banks buying? Gold. What are sovereign wealth funds accumulating? Hard assets. What are the ultra-wealthy positioning toward? Inflation hedges and tangible stores of value. This part is non-negotiable. You cannot opt out of the monetary system. You use dollars every day. but you can opt out of holding all your wealth in dollar-denominated paper claims. You can step out of the line of fire. Here's the moment the clock actually starts. Because the $40 billion per month that begins in December 2025 is not the end, it's the beginning. As we move through 2026 and the Treasury keeps issuing debt, as foreigners keep stepping back, as the private sector reaches saturation, the Fed's purchases will have to increase. 50 billion, 60 billion, 80 billion, the number doesn't matter. What matters is that the trend is set. The direction is locked. The Fed is now the buyer of first and last resort for US government debt. That is monetization. That is the end game of a debt-based monetary system. Let me show you what actually happened in previous episodes of mass monetization. Weimar Germany in the 1920s, Zimbabwe in the 2000s, Argentina repeatedly, Venezuela in the 2010s. The playbook is always the same. First, they print to cover budget gaps. Then they print more to cover the inflation caused by the first round. Then the currency loses credibility. Then the real crisis begins. Now, is the United States Zimbabwe? Of course not. The dollar is the global reserve currency. U.S. Treasuries are still the deepest, most liquid market in the world. American military and economic power underwrites the entire system. The collapse, if it comes, will be slower and more managed than those historical examples. But here's the part they're not telling you. Slower and more managed doesn't mean preventable. It means death by 1,000 cuts instead of one catastrophic blow. It means your purchasing power erodes 3% per year instead of 50%. It means you slowly become poorer without ever experiencing a dramatic crisis moment that forces change. This is where the tension actually doubles, because a slow motion crisis is politically sustainable. If prices rise gradually, people adapt. They complain, but they adjust their budgets. They don't storm the central bank. They don't demand a return to sound money. They accept the new normal. That's what the Fed is counting on. They're betting that you'll tolerate 3 to 4% inflation indefinitely if it means avoiding a deflationary collapse. They're betting that you won't connect the dots between their money printing and your declining living standards. They're betting on normalcy bias. And this is the crack that becomes an earthquake, because at some point the math overwhelms the narrative. At some point, the gap between official inflation statistics and your lived experience becomes too large to ignore. At some point, the rest of the world looks at the Fed permanently monetizing debt and decides dollars are not the safe haven they used to be. When that psychological shift happens, when the confidence breaks, the unwind is rapid. Not because the fundamentals changed overnight, but because market psychology is binary. One day everyone believes, the next day everyone doubts. The transition between those states is violent. We haven't even reached the breaking point yet, but the December 10th announcement moved us significantly closer. The Fed revealed they cannot maintain the pretense of policy normalization. They need perpetual intervention. That's a fragile equilibrium. Here's what I call the big secret of the entire system. It's not that the Fed is powerful, it's that they're trapped. They've created a financial architecture so dependent on their support that withdrawal of that support causes immediate crisis. They're not in control, they're imprisoned by the system they built. And once you see that, once you understand the Fed is reacting to forces they cannot control rather than directing the economy with wisdom and foresight, your entire framework shifts. They're not playing 4D chess, they're playing whack-a-mole with trillion-dollar mallets. That realization should change how you position. You're not trying to outguess the Fed's next move. You're recognizing that their moves are constrained by mathematical realities. The debt is too large, the deficits are too structural, the system is too fragile. They will print. It's not a question of if, it's a question of how much and how fast. The simple logic does not apply here. Normal economic reasoning says inflation should be temporary, caused by supply shocks or demand surges, and should resolve naturally. But when inflation is caused by monetary expansion to cover government deficits, it persists as long as the deficits persist. And the deficits are structural, they are not going away. So the question becomes, how do you preserve wealth in an environment of persistent policy driven inflation? The answer has been the same for 5,000 years. You hold assets that cannot be debased. You hold things with intrinsic value that exist outside the banking system. Gold has survived every currency collapse in human history, not because it's magical, but because it cannot be printed. Governments can confiscate it, and historically some have, but they cannot create it. Its supply is constrained by physics and geology, not by political expediency. That makes it the ultimate protest against monetary debasement. When you buy gold, you are voting no confidence in fiat currency management. You are saying, I do not trust central banks to preserve my purchasing power, so I am opting out of their system to the extent possible. This is where everything changes, because the December 10th announcement was the Fed essentially admitting you are correct to doubt them. They are choosing inflation, they are choosing debasement. They are explicitly prioritizing system survival over your purchasing power. History favors the prepared, and the window for preparation is closing. Not because some arbitrary deadline is approaching, but because each month the Fed prints another 40 billion, the currency loses a bit more credibility. Each quarter the deficit remains at 2 trillion. The math becomes more inescapable. Each year that passes without structural reform, the eventual adjustment becomes more severe. You cannot change the system. You cannot vote your way out of a debt trap this large, but you can change your own positioning within the system. You can recognize that paper wealth is not real wealth. It's a claim on wealth that depends on institutional stability. Real wealth is tangible. Real wealth cannot be printed. Real wealth exists independent of any government's balance sheet or any central bank's policy decision. Friends, the Fed just told you, in plain language disguised by jargon, that they cannot allow the system to function without permanent support. They restarted the printer on December 12th. The balance sheet is expanding again. The monetization has begun. The only question that matters now is, what are you going to do about it? About